Hi friends, I am Faf and you are watching my YouTube channel for Forex Learner. So today I am present in front of you people with another fresh video of our series that we have started about Forex trading. As you people know that we already uploaded 3 videos. So in previous video, last video, we talked about the six biggest forex market movers, or the six biggest, we should say, things that moves forex market. So in that video, we studied two of them. The remaining four of them we will study in this video. So watch the video till the end to understand the remaining four. If you haven't watched the previous videos, so you can watch in our on our YouTube channel. So let's start the video. The first two of them we have also already studied. The third one is trade balance, that how trade balance work and how it moves forex market. Trade balance mean import and export. Trade with other countries is a major part of most economies, and therefore the trade balance can affect the value of a currency. If a country exports more and more goods and services, this will increase the demand for that currency and hence its price. However, if an economy increases its imports over time, this increases the selling pressure on that currency and it should depreciate over time. The trade balance is simply the ratio of exports to imports for a given country. If exports are higher than imports, then the country is said to have a trade surplus, indicating that the demand for the economy's goods and services as well as its currencies is strong. However, if imports are higher than exports, then the country has a trade deficit, indicating demand for the country's goods, services, and currencies is not so strong. As with other indicators, trade balance data is usually released monthly and has a moderate effect on exchange rates. A better than anticipated trade balance could be viewed positively for the currency and result in appreciation, whereas a worse than expected trade balance will have the opposite effect. So now, what is quantitative easing and how it can move forex trading? Quantitative easing. Quantitative easing is an unconventional monetary policy tools that is used to expand a central bank's balance sheet. It is often compared to printing more money as it expands the base money supply. Now, how it moves the forex market? Money supply and inflation are linked, where a higher money supply should translate into higher inflation and lower purchasing power. The USA, Eurozone, Japan, and the UK have all engaged in quantitative easing, with the Eurozone being the most aggressive. Also, the timing of their quantitative easing programs has differed. Therefore, you can use these policies to make trades on the forex markets. For instance, once the US started to wind down quantitative easing, the eurozone geared up for more quantitative easing. You could have sold euro USD over the long term to take advantage of this development. Also, the US Federal Reserve has recently indicated that further quantitative easing may be necessary. If this materializes, then it would be a good time to short a currency pair such as USD ZAR or USD MYR, since South Africa and Malaysia are two fast growing economies that have not needed to implement quantitative easing. Now, the fifth and most important factor that moves forex market is country politics. Country politics plays an important or a very important role in forex. How it work and how it moves forex market, let's discuss in detail. The political situation of a country have a significant effect on its economy. A new president or prime minister might make radical changes to the economy. There's no better example than Donald Trump in the US, who has been increasing protectionist measures by raising tariffs against other countries, introducing more obstacles for trade. Similarly, a revolution or coup can severely affect a country's currency as exchange rates are often based on the perception of an economy. If people do not feel like their money is safe in a country, they will sell that currency and seek a safe haven in a different currency, as a lot of people do. They sell their currency and buy Japan yen in any crisis or any unstable situation, because Japan yen is mostly known as safe haven. So politics is also important for a country's stability. For instance, China has a 100-year plan in place as it is a communist state, whereas many Western countries change their leaders every 4 or 5 years. The relative instability could have an adverse effect on the economy as problems from the last administration are addressed, but a whole new set of problems are introduced, leaving the next leading political party to pick them up once they are in power. So now let's talk about interest rate. Interest rate, you can also see in Japan 1%, in Australia 5% interest rate. Interest rate also plays an important role in the development of a country, and also an important factor which moves forex market. Now, how it moves forex market and how it works, let's talk in detail. Interest rates are the most important tool central banks have, and they are used to influence lending and savings and borrowings. Lending and savings and borrowings are consumption. A higher interest rate incentivizes investment and savings, since people will get more interest on their deposits and receive more interest payments when borrowing to others. However, a lower rate of interest incentivizes borrowing and consumption, since it is cheaper to borrow money for that new car or house someone has always wanted. The rate of interest also affects the flow of money across borders. For example, suppose interest rate in UK are 2% while in Germany they are 5%. People with savings in the bank would move their money into Germany banks to get a higher rate of interest and effect selling their pounds and buying euros. Therefore, changes in the interest rates are high impact events for exchange rate. So in today's video we discussed the remaining four factors which moves the forex market. Hope you all get my point and you all understand the topic. So now I want a short leave from you people. If you haven't subscribed our YouTube channel, so subscribe it, and take care of yourself until next video. See you, goodbye.